I've backtested every single ICT and smart money concept, and I'm ranking all of them from S tier to delete this from your brain. Order blocks, A tier. Let me be honest about what this is. Order blocks are supply and demand zones with a rebrand. The last candle before a big move. That's where institutions build positions. When price returns, unfilled orders get triggered. Supply and demand. That's it. But here's why it's still A tier. This framework gives you a specific candle to focus on, not a vague zone you draw wherever you feel like it. And that precision matters. An order block with displacement behind it, during the right session, in the right market structure, high probability entry. Alone, it's a coin flip, but with confluence, A tier. But there's one concept millions of traders swear by, and it's the biggest lie in smart money trading. Fair value gaps, F tier. And I'm not even sorry. 500 trades, every textbook setup. Win rate, a pathetic 15%. The theory says price must return to fill the imbalance. Here's the truth. Price has no obligation. Every chart has dozens of fair value gaps, and most are pure noise. Now here's what nobody in the SMC community wants to hear. If you actually want to see real imbalances in the market, use footprint charts. Footprint charts show you actual volume, actual absorption, actual aggressive buyers and sellers at every price level, not some arbitrary gap between three candles. Footprint charts are the ultimate tool for reading institutional activity. Fair value gaps are the astrology of smart money concepts. They sound intellectual, they look pretty on Twitter, and they work about as well as your horoscope. Want to know where to actually enter a trade? Use the next concept. Premium and discount, B tier. Take any swing and divide it in half. Above 50% is premium. This is where you look to sell. Below 50% is discount. You look to buy here. That's the whole concept. B tier, because it genuinely works as a filter. It forces directional discipline. You won't buy at the top of a move. But it's basic. It tells you where to look, not when to enter. Simple, effective, boring, but boring makes money. Now for one of ICT's signature strategies. Silver bullet, D tier. Here's my rule. Anything that has fair value gaps as a core component of the strategy is an automatic D for me, period. Silver bullet tells you to hunt gaps during specific 1-hour windows, but we just established fair value gaps are F tier. I don't care how pretty the setup looks, the foundation is cracked. On top of that, markets don't obey arbitrary clock windows. A setup at 10:01 works, but 9:59 doesn't. That's not a strategy. That's superstition with a schedule. D tier. Okay, enough disappointments. Let me show you the single most powerful concept in all of smart money trading. Liquidity sweeps, S tier. The real deal. Everything you learned about support and resistance is incomplete. Price doesn't respect levels. Price hunts the orders sitting at those levels. Price sweeps above, triggers all the stops, then reverses hard. That's not a fake breakout. It's a deliberate liquidity grab. I still remember the trade that rewired my brain. About 5 years ago, I was short gold. Price spiked above the previous high, took my stop to the tick. I watched it reverse and drop 200 points in my original direction. I lost money on a trade I was right about. Support and resistance tells you where price might react. Liquidity tells you where price is going and why. It's the difference between watching traffic and understanding why there's a traffic jam. S tier, no question. Here's a concept that helps you read the structure behind those sweeps. Market structure shift, B tier. Break of structure and change of character. When price breaks a swing high in an uptrend, structure is confirmed. When it takes out a swing low instead, That's your shift. The trend might be flipping. B tier because it's foundational. You need this. But alone it's lagging. By the time structure shifts, you've missed part of the move. It's a compass. Tells you which direction you're facing. Doesn't tell you when to start walking. Essential, but not enough on its own. Now for another concept built on the thing I just threw in the garbage. Unicorn Model, D tier. The Unicorn Model requires a breaker block overlapping with a fair value gap, plus displacement, plus the right time window. 4 conditions, one of which is F tier. It's called the Unicorn Model because just like a unicorn, by the time you think you found one, you're probably hallucinating. Anything with fair value gaps in the core logic gets an automatic D from me. Here's something that actually holds up. Kill Zones, C tier. I know this is going to upset people. London Open, New York Open, specific sessions when institutions are active. The concept is real. Institutions trade during business hours. Volume proves it. But here's the thing. Kill zones are a time filter, not an edge. Saying trade during London Open is like saying fish when the fish are awake. Obviously, but it doesn't tell you which bait to use, where to cast, or when to pull. Useful, yes. A tradable edge by itself, no. Kill zones are a supporting actor, not the lead. C tier. Now for something that sounds far more sophisticated than it actually is. Breaker blocks, B tier. When an order block fails and gets broken, the zone flips. Support becomes resistance. Resistance becomes support. And that's literally what this is, a zone flip. The most basic concept in technical analysis, dressed up in smart money clothing. B tier because zone flips do work. Price retests broken levels from the other side all the time. But let's not pretend this is revolutionary. Your grandfather traded zone flips. ICT just gave it a cooler name. Decent concept, zero originality. Speaking of zero originality, optimal trade entry, C tier. Enter at the 62 to 79% retracement of the latest swing. That's Fibonacci. The 61.8 and 78.6 levels, literally Fibonacci. ICT took a concept from the 1930s, renamed it optimal trade entry, and you now think he invented pullback trading. Does it work? Yes, sometimes. For the same reasons, Fibonacci sometimes works. Self-fulfilling prophecy. OTE is Fibonacci in a trench coat, pretending it's new. C tier. But here's a framework that genuinely changed how I trade. Power of Three, S tier. Again, full transparency. This is heavily borrowed from the Wyckoff method. Accumulation, manipulation, distribution. Wyckoff was teaching this in the 1930s. ICT repackaged it with modern session timing. Is it a ripoff? Basically, yes. Does it work? Absolutely, yes. Here's the framework. Asian session is accumulation, quiet, range-bound, smart money building positions. London or New York Open is manipulation. Price spikes against the real move. This is the stop hunt. 90% of retail gets trapped here. Then comes distribution, the real move. That's where money is made. Once you see the daily cycle this way, you stop getting trapped by the manipulation phase. You wait for it. You use it as your entry. S tier, because it works. Now, the theory behind why Power of Three works, that's where SMC goes completely off the rails. The Interbank price delivery algorithm, F tier. The theory that all price movement is controlled by one algorithm. Price goes up. The algorithm is delivering to buy-side liquidity. Sideways movement, that's rebalancing. This explains everything and predicts nothing. That's not a theory, that's a religion. No matter what price does, IPDA explains it after the fact. Replace algorithm with Illuminati and tell me the difference. F tier. Here's something that actually makes logical sense. Mitigation blocks, B tier. When price returns to a failed order block zone, that's a mitigation block. And just like breaker blocks, this is another zone flip, wearing a fancy hat. Failed support becomes resistance. Traders have used this forever. The ICT framework adds specific rules about which failed zones to watch, which does add some value. B tier. Functional, not revolutionary. Solid old school concept in smart money packaging. Here's something that isn't a full rebrand. Displacement, A tier. Large aggressive candles with full bodies, minimal wicks. This is the visible footprint of institutional money hitting the market. Small candles are retail noise. A massive candle with no wicks, that's a bank moving millions. You don't need a theory to see it. You don't need an algorithm to explain it. It's right there on the chart. Displacement is the smoke alarm. You don't see the fire. The alarm tells you it's real. When you see it, real money just committed. Now wait for the pullback and enter. A tier, because it's visual, objective, and requires zero faith in any theory. You just see it. Next concept is inducement. C tier. Small liquidity pools that induce early entries before the real move. Market makers creating mini traps. Here's the problem. Everything looks like inducement in hindsight. Price dipped before rallying. Inducement. Price spiked before dropping. Inducement. At some point, you are not analyzing the market. You are writing conspiracy theories about candles. C tier. Traps exist, but you can only identify most of them after the fact, which makes them almost useless in real time. Last one before the number one. New week opening gap, new day opening gap, F tier, the gap between sessions. Theory says price must fill it. Price doesn't must anything. Gaps exist because markets close. No magnetic force is pulling price back. New week opening gap is like claiming the space between where you parked yesterday and where you park today has gravitational significance. It doesn't. You just parked in a different spot. F tier. Okay, 16 concepts. Some S tier, some garbage. But here's what nobody talks about. None of these work alone. The number one ranking isn't a single tool. It's the combination. Start with market structure. Identify the trend. Higher highs, higher lows. A break of structure confirms direction. That's your compass. Then find the liquidity. Where is price heading? Find the equal highs, the stop losses, the pools. That's the target. Price isn't going there to break out. It's going there to sweep and reverse. Then session timing. Power of Three tells you the fake move comes early. Don't enter during the trap. See if displacement confirms. Big candles after a sweep. Institutional money just entered. Green light. Enter at the order block that displacement left behind. Confirm you're in discount if buying. Premium if selling. 5 concepts confirming one trade. No indicators. No fair value gaps. No algorithm conspiracy theories. Just structure, liquidity, time, and the visible footprint of real money. That's S tier, not one concept, the system. Now, when I threw fair value gaps in the trash, I told you there's something better. Footprint charts. Every concept I ranked S tier gets 10 times more powerful when you combine it with footprint charts. I made an entire breakdown on this tool. Watch it next. And this is exactly the kind of setup we break down inside our academy. See you inside.